Welcome to today's discussion on building resilient balance sheets and on how banks can help navigate uncertainty. My name is Toby Miyaka, and I'm the Global Head of Crystal Coalition Greenwich's Corporate Banking Research Practice. For those who don't already know Crystal Coalition Greenwich, we are a leading global provider of strategic benchmarking, analytics, and insights to the financial services industry and part of the S&P Global family. Let me start by introducing my fellow panelists for today's session. I'm grateful that two true experts in their respective fields could join today. Let me welcome Jim Gilligan and Tom Halpin. Jim is Senior Consultant for Redbridge's Debt and Treasury Advisory and has a long and successful track record on the Treasury side. In particular, in his role at Evergy, the large utility company based out of Kansas and Missouri, which is actually a composite of the S&P 500. So I think, Jim, you've spent close to 4 decades at Evergy, so it's safe to say that you are a true expert representing the Treasury side in today's discussion. So welcome.
Thank you.
Tom will represent the banking side, as he is heading HSBC's global liquidity and cash management offering for North America since 2022 and has been with HSBC for more than 18 years. Before that, he started his career at JP Morgan. So welcome to you as well, Tom. Good to see you.
Hey, Toby, thanks for having me.
Now, let's kick off by reflecting why today's discussion is so important. I think there are 3 things that come to mind. The first one is that volatility is really the new norm. We witness market fluctuations due to geopolitics, domestic politics, other external factors. And I think it's fair to say that decision-making under uncertainty has become the bread and butter of CFOs and treasurers. So as this uncertainty is a good part of that triggers the external factors, the first line of defense is to actually fully unlock things you can control. So in other words, unlock internal strengths, meaning leverage cash and assets, optimize financial structures, etc. So how do you do that? You do that by harnessing the power of data and technology that we now have more and more available. And there's 2 things that come to mind to really leverage that. One is to unearth all possible areas of strengths. So you first have to find that. And then also to use the data and technology to deploy this capability in the most agile way. With this as context, we want to discuss 3 things. Number 1 is the shifting dynamics between corporates, treasurers, and banks. We also want to discuss the emerging balance sheet strategies for resilience and growth. And thirdly, the role of data and technology in unlocking balance sheet opportunities. Let me share some observations from our proprietary research. I think the first point is that when we ask group treasurers and CFOs, what are the key business priorities in the next 6 to 12 months? The biggest part, so 31%, say it's about balance sheet and capital structure optimization, with a particular focus on refinancing, raising capital, debt optimization, etc. And that's closely followed by the objective to really go for growth and expansion under the uncertainties that we've mentioned earlier. So we also see that in that context, there is an increasing number of DCM providers. And since 2023, we also see a rebound in the average number of banks used. And we also see that, and I'm interested to see later on what Jim and Tom think about this, but we also see that the bank's role is also really evolving, shifting from a lender to strategic advisor, also helping to embed data forecasting and tech tools into the relationship, and supporting long-term planning. So with this as background, let me start off with, maybe we start with you, Jim, to ask the first question. So in today's environment, how are corporates thinking about their balance sheets, and what's changing in the conversation between treasurers, CFOs, and their banks?
Well, first, let me say that you recognize my 40 years in corporate treasury, so I have a little bit of experience in this area. I think in my new role at Redbridge as a consultant, I have the opportunity to work with corporates directly and see exactly what they're looking and seeing in the market right now. So I think overall, the answer to your question, how are corporates thinking about their balance sheet? I think that there is caution. They're very cautious given the environment we're in. But I also see optimism from corporates. We're seeing a lot of activity and interest in in mergers and acquisitions. I think that what we have right now are interest rate questions. Of course, we don't know what the Fed is going to do, whether they're going to reduce interest rates sooner or later. But I think that most corporates are believing that rates will ease and ease sooner. And so that is affecting their decisions with regard to pursuing capital investments and also refinancing or taking on new debt. At the same time, I think companies are cautious, as I said. They're holding on to cash a little bit. They're maintaining strong cash positions just in case, which is driven, as you said, a lot by geopolitical concerns, tariff questions, although I think that has softened a little bit here in the recent month. So basically, I think this all translates into a strategic focus that companies are transitioning to in this environment that we're in. I know we're going to talk about this more, that the treasury function has become much more involved than just managing cash and your your debt facilities. It's more strategic. It involves senior level people at the company, and it also involves a lot of relationships now with banks and advisors such as Redbridge.
Right. Tom, you're working for a particularly internationally oriented bank out of North America. So I think the geopolitical challenges in particular are very close to your daily engagement. So what do you think from the banking side?
Yeah, I think, Jim, I think you summarized it really well. And based upon the conversations that I've been having with corporates and a survey that we've done, I've kind of break it down into a couple of different ways. But I think it really stems back to one factor: the function, if you will, of the corporate treasurer has actually been going through a transformation from one that was much more in line, I'm going to say years ago, with more of a day-to-day, but now it is much more strategic in its engagement, and its engagement across the overall organization that they're a part of, and bringing it in, because the conversations, the feedback that we've gotten, they're clearly, because of the geopolitical, the economic environment that's out there, they're focusing on balance sheet resiliency. They're focusing on the cost of capital, strategic investments. They're trying to get that balance between grow versus stability in a rate insensitive environment. And if I think about some of the risks that they're really looking at, FX risk is a big one based upon the surveys that we have done in terms of an area of focus because of the volatility that's out there. Supply chain risks are at an all-time high as well in terms of their narrative, not only just for the dependency, but actually the cost of goods via the supply chains and what will be happening. Somewhat linked to tariffs, somewhat just linked in general. to even non-tariff related activities with some of the geopolitical tensions that are out there. Climate has actually been a factor as well, because they've got to make sure their needs are being met, their people are being met, and clearly interest rate volatility and interest rate projections are a big part of it. So I think it was 93%, and this really comes back into their ability to manage their cash to a point, cash flow forecasting. 93% of the corporates that were a part of our survey said they attributed some portion of a loss to inaccurate forecasting, that they think they have an opportunity to improve. And I think it gets a little bit back, Tobias, to your early statement when you opened up about how can data play a bigger role in newer and emerging technologies, right? Because we're sitting at the cusp of a data explosion, if you will, in the space. You could look at ISO has increased that. You could look at API's abilities to move things faster. Now the question is, how do you move at the pace of business the data so that you have better insights? Because those insights will lead to actionable decisions that will make you manage your balance sheet on a more predictable, but more so importantly, I think in a more proactive way. So those are some of the things that we're hearing from the treasurers about what are they looking for. And it's the connection to banks in many ways because of the role that we play and the data that we have and how we could integrate back into them, that this is going from a tactical historical relationship to much more of a strategic partnership that they're looking for from financial institutions.
Yeah, great. I think that that's also some of what we see in our research, that banks are much more than maybe 5-6 years ago is seen as true partners now. As it's kind of, we are in it together to manage that uncertainty and risk, and the optimization of that is important. So I think as this webinar is particularly also focused to give insights to group treasurers, CFOs, let's be also a little bit more concrete. And I think the next question I would like to ask, maybe we stick with you to start, Tom. What are the balance sheet strategies you're seeing more often now, and like hybrid financing, supply chain financing, or asset-backed structures that help corporates stay agile while unlocking value? And then after that, we'll see what Jim, in his previous role, but also now working with so many other corporates, what does he see?
Yeah, I would highlight a couple of things on here. I think when it comes into the rate environment, the interest rate environment, I think you're seeing this mix of a shift potentially, or rebalancing, rethinking of how much fixed versus how much variable do you want, how much on balance sheet versus off balance sheet, because there is that need to manage the predictability of their portfolio, but yet that charter that they still have of how do you grow is out there. I think we're seeing a lot more too in terms of how do they look at some of their FX activities and look at the volume of business and activities that they do, whether or not they start taking different types of positions on the currency pairs that they do and the markets that they do. To hedge is a big piece of what this really comes down to. We've had some customers, I'll give you a real specific example, that have gone from one approach to basically thinking about how do they leverage CDs, time deposits, in a different laddering approach. So they have short-term liquidity, if you will, but better, higher yield on that versus just leaving it stale, if you will. So trying to optimize it. I think lending is always going to be a big conversation point when I've talked to some of the, depending upon the sector that they're in and where is it going. I've had some corporates turn and say, we're very cash rich and we're going to keep that position and we're not going to build that debt right now, given where the cost of debt is in their mind. And it's a luxury, but they're looking at that lever of saying, where will things stabilize, and will they potentially take their position? Because this is in one sense an opportunity, in speaking to them and some of them, to do potentially some M&A activity that they want to take a look at, and what's the best way to take advantage of some of the market disruption that's out there to grow. But how would you want to finance that activity? How do you want to manage that activity? So they are truly being exploratory in a lot of different ways on how they want to manage that. But I think the key thing is optionality, flexibility, and the need to make sure that they're liquid to the appropriate level has been heightened. So that's why they're looking at a lot of different instruments from my perspective.
And I think, what we see also when discussing with corporates is that optionality is also being enhanced by that data and analytics side, which the banks actually can play quite a big role, because it's one thing is to have capabilities to use that data, but also to have the clean data to start with, right? I think a lot of times people forget that you have to have a clean data set to start with, and banks in certain areas are in a very good position to provide that, more so than some of the corporates to kind of reinvent the wheel. So I think that's the really interesting part that we see increasing in kind of the change of interacting with banks. But maybe back to Jim, to you. I mean, in your current practice, as you have so much exposure to the corporates, what are the balance sheet strategies you're seeing, and maybe talk about the hybrid financing, which it's top of mind for a lot of people, right. Supply chain financing, etc.
Well, Tom and I are on the same wavelength, which is a good thing, I suppose. So really, I will concur that absolutely corporates, and we see this, are trying to stay agile. So, when you look at the current balance sheet and the debt on the balance sheet, I think corporates are trying to manage that effectively, and you make sure that they don't bump up against covenants, and they're managing leverage so that they don't face a possible downgrade by rating agencies. That's very important. And then having that off-balance sheet strategy, or we see more of a transition to that as companies have become more knowledgeable about off-balance sheet financing that I think comes from the major banks and their education of treasurers, and more comfortable, and treasurers are more comfortable doing that. So we see, the standard, you have standard converts, but I think what we see a lot are more asset-backed structures, particularly asset-based lending, loans that are secured by receivables, for example. So, and I think all of this matters again because it gives the corporates the ability to be flexible. Again, this interest, as I said before, in possible M&A activity, that having that clean balance sheet means they're flexible in their financing, and that makes them more attractive to investors and for them to go out and acquire other companies. I would like to make a comment, though, that you referenced earlier, Toby or Tom, on cash forecasting, and the way that corporates are always, and to me, always complaining about their cash forecast. I think in my entire career, that if you go to a seminar or a conference, that is always one of the number one attended sessions, because it's very hard to get your forecasting around the nuances and the difficulties and technicalities of what drives cash flow in a business. So, and you see lots of vendors, third-party vendors and banks helping corporates kind of get their arms around that, but I think it's an eternal problem that just goes on and on and on. I don't know if there's a solution to it. The other thing I wanted to touch on is just this whole idea of AI. I know there's a lot of discussion about AI. Of course, there's a lot of new technology that's coming out on AI, and I think that still corporates have a tough time getting their hands around that. To your point, Toby, I think having data analytics ability in-house, which is what I'm seeing, that larger companies are going to colleges and they're recruiting new graduates that have that skill set and trying to include it in their toolbox internally. So there's great future to go, but at the same time, I think corporates are really depending upon banks, and third-party consultants like Redbridge to help them navigate through this uncertain time, and that's driven by a few things. Like Treasury departments are notoriously small and overworked, and so if you don't have the time, or you don't have the bandwidth, and you don't have the internal ability, then that's where banks and consultants like Redbridge come in to help corporates. And I think we're seeing more and more companies do this, and I think that is also being pushed down to lower, like middle market and small market companies, not just large cap companies.
And Jim, to that point, I think it's one of the more, I think that's why the conversation has gone from that transactional element to that partner element, if you will. Absolutely. Because to your statement, the corporates need it simple, and they need to consume a lot of information. So the more fragmented their markets are and their providers are, the bigger challenge it becomes to them to ingest this. The more that they could look at different bank providers and just different tools on their side and have their partners present it in a way that they can consume it, will accelerate their pace. Because you're right, you could have AI, but AI starts with great data and structured data that's meaningful, so that you could then expand it. It's not putting, as they always say, right, garbage in, garbage out. So you've got to get a really good data set going in that's meaningful. And I think banks are uniquely positioned to create some of that insight for them.
Agree completely. Toby, we interrupted you.
No. It's great if that's flowing. That's what we want, right? So I think just on our observation, that we just finished a global study on the influence of AI and the use of AI. I think one of the key takeaways is that no corporate that we've interviewed, and that is across the globe, said that they want to reduce or think about reducing investment into AI. At the same time, Jim, to your point, the vast majority is still in an exploratory stage, so they're not yet using it fully. And if they are using it, it's more of the automation of more manual tasks, but it's not at a point yet where there is a real decision-making element to it, right? So I think that is evolving, but it's evolving very fast. And to Tom's point, the data sets you have to put in, I mean, you can do that even, you know that from your maybe private use of ChatGPT and other tools, that if you don't prompt the right way, if you don't put in the right data, then obviously what comes out is not really helpful. So I think in that, we have to collaborate from a consulting point of view, from the corporate point of view, and obviously the banks have a big part in that to provide that clear data in the first place. So anyway, so I think this is already a great segue to my other question, which is, how are corporates using bank tools and data to identify underutilized assets or working capital opportunities that strengthen their balance sheet position? So maybe we start, Tom, with you, as that's bread and butter of what you do when supporting your clients at HSBC.
Yeah, I think there's a couple of things that our corporate customers are looking to us to help them with, right? Jim, you said cash flow forecasting is going to be there, and you could never, get it better, never get it good enough, right? It's always going to be, every time I think you hit the ceiling, it's a new floor, right? Because the world isn't staying still, and there's a need to constantly accelerate the pace of information exchange and insights, not just always purely data, but insights gathered by it, because banks sit on a wealth of information about what's happening in markets that may give broader awareness and attention. So our cash flow forecasting tools and how we deliver information relative to that, if they have their own, is growing in importance and need. But I also think it's coupled by the real-time visibility and insights to different activities, because a lot of the things come down to payables and receivables, right? Our trade financing team here at HSBC is actively working with customers on how do you work with ways to improve their working capital, and we actually come into them with a solution on working capital that will bring the payments business just as much as it'll bring the trade business, right? Because it gets back to, where is the customer in their journey basis? Do you want to deliver it just in time so you optimize the return that you're getting on your balances and your deposits? Do you need long-term or short-term pieces? So our working capital analytics, our cash flows, but I think it really is all harnessed by the ability to make it available where our customers need it, when they need it, and giving them not just reports, giving them insights to help them run their business. Because as one corporate told me, I could create a report based upon data. That's not the value add of a bank. The value add of what HSBC does for them was when we were taking it up a level and applying our knowledge. Because I don't want to use the word advisory, because I think it's overused in many ways, but it's that partnering dialogue about what we're seeing and insights and how we're applying it, right? And especially in our case, because many of our, and Tobias, you said this, many of our customers are using us in 10, 15 markets around the world, 20 markets around the world that we're in. So that understanding that we could bring to them, or awareness that we could bring to them, bringing and consolidating their business back into a single view, a single solution set that meets their needs, as opposed to being, well, you're fragmented around the world, because they are looking for operational efficiencies through this. Everyone always thinks about its top line growth. No, it's overall growth that they're looking for, right? It's bottom line. And that means we have to make them more efficient in what they do and help them lean forward even more. It's not just the top line, it's the whole business that they're looking for us for.
Yeah, absolutely. So Jim, anything you see in particular with your practice right now on what corporates are using bank tools and data for?
Well, I think it goes back to a comment Tom and I both made at the beginning of our conversation here, that I think that we're seeing treasurers have a more strategic role, that the job has evolved from being just transactional to being more strategic and transformational. I personally think that large banks like Tom's and others provide a vital role to corporate treasurers for a couple of things. Number one is education and knowledge and training that they can't obtain from just going to seminars and conferences. The other thing is that the large banks have investments in sophisticated platforms and software that treasurers can utilize to make this leap out of just being a transactional role in the company. And it's not one bank. One of our roles that we do at Redbridge is we come in as an independent advisor. Sorry, Tom, I'm going to use that term. And, we see all kinds of different platforms and products across banks, and different banks have different specialties. Just international versus domestic. And so we help corporates navigate this. But to my point, the fact that banks do this and they provide the infrastructure, if you will, is invaluable and needed in the corporate treasury world.
Great. Yeah, so I think we are coming to the end of our recording. So let me, I think, close with just summarizing that while we all agreed that the uncertainty under which CFOs, group treasurers have to work is it's really overwhelming. At the same time, I did hear a lot of optimism from your comments in that is not something that cannot be managed, right? So there's a lot of new tools out there. There's a lot of willingness to help in a collaborative way from different parts, third parties, be it banks, be it advisors, be it technology advisors, all the rest of it, to manage the situation. And there is with that also optimism with a lot of corporates to grow and continue growing in a healthy and in a secure way. So I'm glad that we have such a lot of optimism here, and I think it's actually true. Looking at the many interviews we do around the world, thousands and thousands of group treasurers we talk to, that is something that we see, in particular in North America, I have to say. So glad that you have been willing to share so many insights, not only from your long-lasting insights from all these years of practice, but also what's happening right now as we talk about it and speak about it, and have to tackle the challenges as they come along. Thank you very much for your participation, and looking forward to maybe have another webinar very soon. Thank you very much.
Thank you, Toby.
Thank you. Appreciate it.